Alright, bam, I'm gonna be so real with you guys. I'm exhausted, but I have to record the video. It is what it is. This is episode 4 for value gaps. How to spot, how to plot, and then we're also going to how to spot, how to plot. And then we're also going to add in how they get formed and how to trade off of them, because we want to know how to trade off of them. It's very important. I have a great example in gold, and I know for my people that traded NAS, there was also an example. NAS and S&P, there was also a really good example. But with gold, I mean, it's a great example right here. Should I have taken this trade last night? Yeah, we would have made. Oh my gosh, we would have made. It would have been a really good night targeting these highs. That would have been like a 6.3. You could do the math. Right? Entry would have been down here. But we'll go into it, why it would have been down there, because of the fair value gap and everything of the sort. So let's get straight into it. What is a fair value gap? I need you guys to know this. A fair value gap is an area within the market where there's no contradicting orders. This area, and I'm not reading off the script, no nothing. This is just off of what I'm thinking. This area, now remember, this area is in between two candlesticks. Typically it's between two candlesticks. Majority of the time it's in between two candlesticks. All of the time it's in between two candlesticks. Let me show you a photo example. Shout out to my boy Jades in the Discord. He sent this image. But if you have to picture a fair value gap, this is how it looks. Of course, I could have shown you on my chart, which we are going to go into, but this is how I want you to picture it with the description I gave. An area within the market in between two candlesticks that has no contradicting orders. Let's say it in fifth grader terms. Empty space within the middle of candle. Got it. Empty space, middle of candle. That's it. It's really empty space in the middle of candle with no wicks. That's the best way to get it, right? So that's that. Now that you understand that, let's go in on how to properly plot them. You always want to plot them. In this image, you can see it's 1, 2, 3. There's 3 candlesticks residing in this image, right? Let's go on a daily time frame.
See you later.
Sorry, it's loud. Let's go on an hourly time frame. 4 hour.
Okay.
So, what do we see here? If I go back just like this, what do we see here? A gap within the market, right? On the way down, and we also see it here too. But an example where we don't see it is somewhere like here. There's no gap within this candlestick, right? No empty space. Wick closed here, candle opened here, came back up, filled it, pushed price to the downside. There was no, there were contradicting orders residing within this area. I had to think of that. But now if we go to an example, something like this, with this bearish push down, we could see there was no contradicting order and or orders pushing price. Wait, let me cook. There were no contradicting orders pushing price back upwards, wicking, filling this imbalance. So what does that mean? It means that when price retraces into this area of having no contradicting orders, we can see the potential of those contradicting orders getting filled. Bam. I cooked. Don't lie. I cooked on that. So I'm going to say it again. With these fair value gaps, these imbalances, also known as, when we see an imbalance get formed, we can tell there are no contradicting orders. So in this candlestick, there were no opposite buy orders pushing price, filling this, right? The selling momentum was continuing, meaning when we retrace, if we retrace into these price ranges, let me show you the example. Price range of 195354 to 1997.65, we have the potential to see those contradicting orders get filled. So sells here, right? When we retrace into it, we have the potential to see those sell orders get filled back to the downside. Why? Because we had to have the buy, in this sense, the buy retracement back to the upside, right? That buying momentum pushing price back up, being able to fill more sell orders, pushing price back down. Almost like, think of it as market filling in this empty space in between here. Before, there were no candlesticks here. But you get to a point to where now, if you go here, now within this gap, this most simple way I could put it is there's a wick now within this gap. I don't want to overcomplicate it because a lot of traders do. It's very, very, very simple. And fair value gaps are a majority of time frames. There is no fair value gap here. There is a fair value gap here. And of course, like always, I'll cut the clip, plot out a few, and then we'll go into it. But I mean, that's just a few examples. So you got the actual definition term of it. You got the image term of it, which is this. This is the Discord, by the way, if you want to join. Links in the description. It's free. And now you got the chart term of it. So I'm going to go in, I'm going to plot a few examples, and we're going to come back and break down each one together. Break down when they're formed, why they're formed, and how we can trade off of those levels, use them as retracement tools for better entries. So let's get into that. Okay, so I went out and plotted a few. I probably plotted 4 examples. This is on a 4-hour time frame. We can also go in on a 1 hour. I mean, these are on 15-minute. I 100% will show 5-minute and 15. Why? Because I know some of us are scalpers, so I want you guys to be able to see this not only on higher time frame but also lower. But remember, everything applies for it. It's universal, right? So right here, this is our first example. Let's go into when the liquidity sweep, spoiled it, when the fair value gap is actually created. So fair value gap is part of the retracement tools we use in order to get a better entry on price action if we don't enter on the liquidity sweep. Remember, good retracement tools, fair value gap, order block, and I guess you could say equilibrium. I don't trade with equilibrium. Equilibrium is when price is in a discount in order for banks to buy. I don't typically use equilibrium. I know traders that do. I don't like it. Some traders do. If you want to know what that is, I mean, I can make a video on that too, but you could search it up and Google it. They'll probably have the answer. So, unless you want me to. Or join the Discord and ask a question. But anyway, actually getting into it. When is a fair value gap created? Well, remember, fair value gap is created when there's no contradicting orders residing within one candlestick. The fair value gap is typically plotted from the previous candle's high of wick. So right here, the close, well, the high is 1939.9760. The high is right here. That's the high of this candle. And then the candle, the other candle after this middle candle right here is low. So this candle's low of 1944.90. Sorry, I was saying bye to a friend. And from here, the high to the low of those two candlesticks, that is where the fair value gap is created. That's where the imbalance is. Why? Because there are no contradicting orders residing here. If there were contradicting orders, this wick, this low of 19,944 would be a lot lower. I wish I could draw an example, but I can't. Whatever. Hopefully you guys get the point though. So, an example right here. Bam, bam. This is the trade I was actually looking to take last night. I didn't take it because of CPI. I didn't know how if CPI was going to be bullish or bearish, but this is what would have been the outcome if we had taken this trade. That's today. So, I also want to note this too. When is an imbalance invalidated? An imbalance is invalidated when there is a candle close past the imbalance. If there's a wick, you're good. A good example is something along the lines of, let me see if I can find a good example for you guys. this imbalance right here, this hourly imbalance, is still valid. Why? Because price did not close above it. Right here. That we don't need to open MetaTrader. Why? Because I'm accidentally placed 50 million trades. Anywho, right here, this imbalance was no longer validated when we closed past it. Obviously, look at this close. That's a close if I've ever seen one, right? So this is no longer validated due to this close. Closing below it. Capiche? Capiche. But if it wicks past it, like a good example, something like this, and rejects, because remember, wicks stand for rejection. This is on a 4-hour time frame. I can't find this. Where is this? I lost it. Right here. This is still valid, okay? So I want you to understand that. Just because it pushes downward on that specific time frame of the fair value gap, if it closes past, it is no longer valid. Remember that. And that's how you know whether a fair value gap is validated or not. Even if there's a body close within the fair value gap, that's okay. As long as there's no close past it. Remember that. So, with that being said, the fair value gap is created, let's do this, when price, now you can start to see our building blocks playing together. Price sweeps, takes out lows for liquidity, forms. What does it then form? Remember, the liquidity sweep, that leg down creates then an order block. Okay, now you're following along. Then, what happens after that? This major rally up, 4-hour, there's no contradicting orders. So, we can use the 4-hour fair value gap as a retracement tool in order to get a better entry, which is exactly what I should have done last night. I didn't do it. Boo-hoo. Miss out on some moves sometimes, but it wasn't my time to trade, so I'm not really complaining. Anywho, and then this 4-hour fair value gap was formed due to there being no contradicting orders. You could see even within this very, very, very bullish 1-hour candle, right? And that is when the fair value gap is formed. Remember, there won't always be a fair value gap formed, though. There will be instances where price comes up, takes out highs, and doesn't need or have a fair value gap in order to retrace to. For this example, there are no contradicting orders. Price, remember, from this low, 1974, to this high, 1968, that's where the fair value gap was. Price retraced, it did not close above, it closed in the fair value gap, don't get it wrong. Closed in the fair value gap, never closed body above, push price to the downside, right? Another example right here. From here to here, low to high of the two candles, not the middle one, where the fair value gap was. Price came down, retraced, rejected, pushing price back to the downside as a retracement tool. Like I said, that's why I say you can use these as retracement tools. Price came back up, almost tapped back into it again, didn't, but eventually the fair value gap was broken when price closed above it. Following along, now for this last one, this one being with the wicks. See, price formed from this high, 1957, to this low, 1960. Imbalance, fair value gap, same thing. Price came down, retraced, rejected, pushed price back to the upside. That's it. It really, and then actually, funny enough, it happened again. It happened again over here. So before price got that other momentum pushing price further down to the downside. So take note of when an imbalance is no longer valid. Another good example, right here. Price came up, took out highs on a 4-hour time frame. This entire thing is an order block. That entire move, well, it's actually from here, it's an order block. We didn't need a fair value gap retracement. Price didn't create a fair value gap retracement. It won't always create a fair value gap retracement, and that is okay. price, you don't need to sit, unless that is part of your strategy, you do not need to sit there and wait for a fair value gap retracement. That's why I testify to other means of retracement tools, order blocks, fair value gaps, equilibrium. Like I said, I don't use equilibrium, but I know traders that do, and all of the sort, right? Or even just developing something on your own end that helps you clarify, okay, price is reversing, let me get a better entry compared to entering on a break of structure, right? Because majority of us, let's be real, we won't enter on the liquidity sweep unless we know it's a liquidity sweep prior to that. Not saying you can't, you 100% can, but it's just being able to take precaution and get your entry in at a better, more, not that liquidity sweeps aren't validating, but even a fair value gap is very, very validating if you have your stops above or below it. So apart from that, that's for value gaps. What I go into, what they are, how to spot them when they're formed. I will show one more example of when they're formed. Right here. Price came down, swept lows. This was liquidity. Bam. Formed what? An order block. Why? Because remember that leg down is that order block. This area, this price range right here. It's turned into the order block. Then price pushed up, rallied higher. Created a what? Where's the fair value gap here? I want you guys to tell me where the fair value gap is. At what price point is a fair value gap? Like, which candlestick? Tell me when to stop. Hopefully you told me to stop here. Because yes, this is where the beginning of the fair value gap is plotted, and tell me when to stop again. Hopefully you told me to stop again. Right here. Bam. And that is where the fair value gap is then plotted. In this sense, there was a fair value gap. Like I said, there won't always be one, but if you want to wait for a retracement tool like this, you can. But this is when the fair value gap is formed, after the overall move of the liquidity sweep. Make sense? Capiche? Capiche. And of course, you can find fair value gaps located within order blocks and vice versa. You know, order blocks located within fair value gaps all go hand in hand. I did want to say I'd show you on a micro time frame, so I'll do 15-minute because I know there's a bunch of scalpers here, and then that will finish off the video because this is a pretty self-explanatory video. I don't want to make you guys overthink it because there's no need to overthink it. It's very, very, very simple. So, and then I'll give you your guys' homework right here. Well, actually, we're going here, bam, sweep right here. It's liquidity, right? Took out highs, formed the order block, and note, in this sense, the fair value gap, funny enough, was formed before the order block, right here, bam. You have a 15-minute fair value gap someone could have entered on, playing that retracement. You can see right here, price came back in, wicked, pushing to the downside. Could have gotten an entry in just like this, bam, short position, entry in fair value gap, stops above highs, well, stops above those highs, targeting these lows, whatever. But, you know, let's just make it simple, right? 1 to 2, easy, bam, in and out of the market. Nothing new, nothing crazy. That's one 15-minute example. I'll show two more, just because I feel like being nice, right? Bam, right here. Price came up, took out highs, just like this. Bam. Oh, let me plot the liquidity sweep. Bam, just like that. Bam, bam. See, now you should be getting to the point where you could start spotting these on your own. And if you can, and if it's not like secondhand nature to you or muscle memory, go in and back test. Keep going into the chart and keep plotting these over and over and over and over. Go on one pair and back test it and plot it all the way until the beginning of that pair. I've gone all the way to the 1800s of fair value, like on gold, to all the way to the 1800s. I didn't even know you can do that. You think I'm lying? Nah, I'm not lying. I am not lying. Look at this. 1833. We're catching moves in 1833, 1863. I wasn't even alive. I didn't even know gold was traded in 1833. That was back when Abraham Lincoln was president, I think. Obama? Somewhere along those lines. I'm be real. I was born to. I don't know my presidents. I don't even know who was on the $100 bill. Benjamin Franklin. Benjamin. Yeah, we kind of Benjamins. You feel me? Okay. Anyway, show one more example in 5 minutes, and then we'll call it a day. And then your guys' homework is going to be go in and plot this 20 times. Go in and plot it 25 times. And no, I'm being very, very lenient with you guys, because I would go in there and I plotted 800 times. That's how I got it. That's how I started to understand it. And if you're not willing to do more than the person that is already ahead of you continuing to do more, you will never catch up. So I recommend you guys sit there and plot it 800 times. Sounds crazy, but crazy is not normal. Do you want to be normal? We're traders. We're not meant to be normal, right? If you want to be normal, you can be normal. That's you. That's your problem, right? I'm trying to help out. I can only help so much. But the goal is to not be normal. So go out and be an anomaly. Go out and do the over-excessive stuff that no one wants to do. Because no one wants to sit there and plot it 800 times. Who wants to do that? I don't want to do that. I didn't want to do that, but I did anyways. Who cares? You have to do the things you don't want to do in order to be able to eventually do the things you want to do. Right? Correct? Sorry, I'm trying to find an example. Actually, perfect. On the 15, this is the exact same thing, right? On the 15-minute thing I just plotted. The fair value gap was, well, let me show the liquidity sweep first. Bam, 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 liquidity, order block, overall order block, but fair value gap, this to fair value gap didn't get fully tapped into, but you guys get the picture, right? You guys are starting to get the picture. If any of you need help with this, hit me up in my Discord or hit up the mods in the Discord. The mods can help too. We got mods now. They're my friends. They're not the best mods, but you know, I appreciate them. I love my mods. So don't diss my mods. My mods are my mods. They're not your mods. Anyway, apart from that, you guys know your homework. Go out, plot it 800 times if you're dedicated. If you're not, shoot, then stay a loser. I don't know what to tell you. I'm joking. That's harsh. I love you guys. You guys know that. But apart from that, that was episode 4 of Fair Value Gaps. We will get into proper breaker structure and all of the sort, and then soon being able to put everything together. Then we're going to go into the hardest part of trading, the psychological aspects, the little mistakes that you guys are making that are holding you back from actually advancing your trading. To me, that was the main point with the series. Anyone can get technical analysis. That's easy. Actual aspect of trading, and when you're actually going into the charts and those little tiny things that's holding you back from actually being a great trader, those are the things people struggle with, and that's why I'm here to help. There's so many free courses online in order to teach you technical analysis. You don't need my course. You don't even need to sit here and hear me talk. But I mean, enough of me rambling. You guys get the picture. I love you guys. Go out, backtest. Go out, continue to kill the market. Execute on your highest probability days. I love you guys, and I will see you guys in the next video. Peace.